Welcome everyone. Today I'm going to be talking about how to invest in shares for Australians. And if you're not from Australia, there might be some valuable tips for you anyway. I only get to the nitty-gritty at the end in terms of specific Australian share investing. Now it's super easy to get involved in the stock market or buy shares. All you got to do is find a share dealer, and if you go to a back alley, preferably at midnight when it's super dark, probably very dangerous, and you'll see a guy in a hoodie, and just sort of like you go up to him, hand him a $20 note, and he'll kind of slip you something, and that should be some Tesla shares. So let's go ahead and do that right now. All right, so we've got our Tesla shares, and no, I'm just kidding. As you probably know, I'm just joking, but it is fairly easy to get started with the stock market. And I've watched a couple of these personal finance videos already. So what I wanted to do to make things a bit easier for you, because there might be different people at different skill levels that want to learn different things. So I'm going to timestamp the different topics I'm going to talk about in the description below. So if you're a bit more advanced and want to skip some of these topics, you can go below and go straight to the topic that you're interested in. But what I'll be talking about is what a share or stock is. What does it mean to invest in the stock market? Why would you want to invest? Should you invest? Key methods of investing, so what are the types of investing strategies? How to actually buy stocks and ETFs on a specific platform? And finally, how to choose a brokerage account that might be right for you. So without further ado, let's get to it. First up, what is a share or a stock? Now these terms are generally interchanged, and you can use either or, but on Investopedia I really like their definition where they kind of separate the two into two different concepts. So a stock, according to them, is the ownership within a company, and this ownership can differ in the type of ownership and also the type of stock that you can get. So there are different kinds like preferred, common, and other types of stocks that are available within a company. And all you really need to understand as a beginner is that it gives you different rights within the company. It may give you upfront payments, it may give you voting rights, it may give you control. There are different things that those stocks can give you. Generally, most of the time, the stocks that you're buying on the public share markets are public common stocks, which generally don't come with any voting rights or anything special like that. It just gives you partial ownership. And we'll talk about what it actually means to own a company later on in the video. A share, on the other hand, is the smallest denomination of a stock that is publicly floated. So the equivalent of that is the fact that money has a denomination of dollars and cents, in the same sense that stock has a denomination of shares that you can buy. So when you buy on the public markets, when you buy one unit, that is one share of that company. What does it mean to invest in a stock? Now, this is a really interesting question, and I wanted to bring it back to how companies operate and raise capital in the first place. Now, generally when a company gets income, they sell a good or service and they get money in return. So if I sell my coffee, I get money in return and I can grow my company that way. But sometimes you need to raise capital because you may not have enough cash flow to do the expansion or do the activities that you would want to do normally. And so there are two different options for you to raise capital. One is equity and the other one is debt. Equity means that, very simply, and I'm going to simplify this a bit, is that you sell a portion of your company in exchange for cash. That cash hits your account, and now you can go use that for research and development, to expand your business and all these other activities. The other option is to do debt, where you take some money and then you pay it back over time with some interest. So when it comes to equity investments, generally the people that can invest in this are professional investors, venture capitalists, high net worth individuals, or what we call accredited or wholesale investors that have a significant amount of capital. These are locked to normal retail investors. There is a special type of fundraising that involves equity called initial public offering, and that basically signifies the change from a private to a public company. It's when the stock now becomes floated and publicly tradable to the mass market. Now anyone can go into their share platform, buy a stock in that company, and then also be able to sell it with ease. And that signifies the main difference between a private company and a public company. So when a public company does this type of fundraising, they get cash from everyone buying into their stock and they keep it. In exchange, everyone now has the ability to publicly trade that stock, and the price now can do whatever it wants based on economic supply and demand, and also other variables that people and analysts are looking at, such as their earnings per share and other statistics. Now, this is what it means to own a company. When you buy shares in these publicly listed companies, you will now have ownership and therefore some of the rights to the profits of the company, to the growth of the company when it comes to valuation, and all the other benefits that come from owning companies. Now, I also want to take this opportunity to mention that there are a multitude of different financial instruments that come with stocks being listed, and you may have seen them: CFDs, options trading, and all these other available financial instruments for you to be able to invest your money. Now, as a beginner, you would not really go straight into those things. You would first dip your toes into stocks and start investing and put some money into there, and then later down the track, expand your horizon to these different financial instruments. Okay, so now you understand what it means to own the company or to buy stocks on the public market. But why would you want to do so? What is the benefit of being able to invest? Now, a lot of people have said that the individuals don't get as much benefits as the companies when it comes to tax, when it comes to making money, and the dichotomy between the rich and the poor. Now, this gives us an opportunity to benefit like companies do. By buying into companies, we now own those companies and therefore get a taste of what they generally benefit from. There are two main ways that you can benefit from owning a stock, or why you would want to own a stock. The first one comes to growth and value. When a company has good value in terms of growth, and you see a potential for it to increase its revenue or profits over the coming years, that shows an opportunity for you to buy in and therefore benefit when the valuation of the company goes up. Now, these are publicly traded companies where people can buy and sell at their whim, and therefore you may see that the market doesn't necessarily follow what the stock value actually is. However, from the most part, if you see value in a stock and you're seeing it's undervalued because there is growth potential in the future, and right now it's $5, and based on your calculations, you think the earnings per share, revenue increases, and all these other metrics for growth indicate that the stock should be at $10 or $15 in the upcoming years, then that's a buying opportunity. Conversely, if you see that right now the stock is undervalued because of the earnings per share, revenue, and other metrics, and the stock price doesn't really reflect what is happening with the company's current statistics, then that is also a buying opportunity. The second way that you can make money by owning a company is essentially the same way that business owners that own a cafe and take money out of the profits and put it in their pocket. It's a very similar way of making money through stocks. But in this case, they pay through dividends. Now, business owners also pay dividends to themselves. But in this case, from a public perspective, when companies make a profit, and not all companies have to make a profit to pay dividends, but most of the time when they make a profit, they can decide to keep some of it for R&D, research and development, and expansion activities, etc., and then decide to pay out the rest as dividends to stock shareholders. So just like how business owners now can get money back from their business, you can get money back from the stocks that you own because you own those companies. Now, there are other ways to extract value from your stocks, such as stock buybacks and other sort of strategies that have become more popularized in recent times. But just know that essentially there are ways for you to extract value by owning these companies, and when these companies perform well, you also perform well. This is also not black and white, so there's not just one way to extract value from stocks. There might be a multitude of different ways. You may think that it's a growth stock, that they do stock buybacks, they also pay dividends. There may be several different things that companies do to make you interested as a shareholder. And it's just up to you to find the best opportunities within the market of things that you're interested in, see financial promise and growth in the future. Should you invest? Now, this is something I wanted to cover because not everyone who's watching this video is ready to invest in the stock market just yet. There are other things that you should be considering before putting money to the stock market because this is not a risk-free game. First of all, you should make sure that you have an emergency fund. Generally, people look for 3 to 6 months of their current expenses monthly to be able to survive if they were fired or something severe happen, just like right now with the disease that's sort of going around across the world, you need to think about Murphy's Law. What can happen will happen, and therefore preparing for the worst. And having an emergency fund is extremely important. So if you spend $2,000 a month on rent, groceries, and all those sort of things, then you should aim to save from $6,000 to $12,000 and have that in a high interest savings account ready to go. That should not be invested. It should be liquid enough for you to be able to use it when the emergency comes. The second thing that you should consider is high interest debt before actually investing in the stock market. And why this is important is because if you have a personal loan with interest rates from anywhere up to 20% or even higher, then you really need to think about how you're going to pay that off before you invest in the stock market. The annualized average interest rate for stock markets and how much you can expect to gain is most likely less than the high interest debt that you're having to pay off for credit cards, for personal loans and things like that. So really think about the interest that you're accumulating and the debt that you need to pay off before considering investing in the stock market. Okay, so if you have your emergency fund set up and you have no high interest debt to pay off, then perfect. You have the disposable income to now look at investing in the stock market. Key methods of investing. Now there are a couple of ways to get exposure to the stock market aside from just buying individual stocks. The first way is through managed funds, and that's essentially when you give your money to someone else to manage for you. They invest it, they take care of all of those things for you, and you don't have the headache. Now the con of this, even though it sounds super easy and super simple, is generally the management fees are extremely high. And I'll get to an example of where we compare a unmanaged fund or a more automated fund with a managed fund, and you can kind of see the differences, but just know that there are high fees involved with a managed fund. Next we have index funds. So index funds are really interesting because all they do is track the market in some way, shape or form. There are different indexes that are used across the world to track a basket of different companies. So if you look at the S&P 500, the ASX 200, NASDAQ 100, Russell 2000, they're different market tracking indexes to get different kinds of exposure. So if you wanted to get exposure to top Australian companies, you would look at ASX 200. The top American companies would be NASDAQ 100 or the S&P 500. Or if you wanted the very small companies, like the small cap companies, then Russell 2000 is what you're looking at in America. So different market tracking index funds. Now the big perk with index funds is 90% of fund managers don't actually outperform the market. Most people underperform the market. And so if you think about the statistics, for you to be able to find a managed fund that outperforms the market is very rare. And if you do, that's great for you. If not, then an index fund is probably the way to go. The other benefit of an index fund is the fees are way lower than a managed fund. So just to give you an example, we have the VOO, the VOO, which is the S&P 500 index fund, and the fees for that can be as low as 0.03%. And when you compare that to a managed fund of 0.29% or even higher in some cases, that can be an extremely costly decision over the long term. That's almost 10x in terms of the funds that you're looking to pay. And whilst 0.29% sounds like a very small amount, compounded over time, and when your account becomes bigger and bigger, that's a significant portion of your wealth that you do not want to be investing. Another way to consider these fees is the fact that if you take 0.29% as your fees and the average annualized return for the S&P 500 since inception is about 8%, you're looking at about 2 weeks of your growth that is taken away from you every year. And so compounded over your lifetime, that's a significant amount of time that you're losing in terms of growth. And so when you think about it in time and aside from money, then you have a different perspective on how that growth is really being impacted. And finally, the last way to invest is looking at individual stocks and buying them. Now, this would take a bit more research on your half, but if you start getting more interested and start researching, and especially since I'm going to be pumping out more of these videos every week about stocks, then that's definitely something that you can look into doing. But for the most part, index funds are probably your best bet to get exposure. And if you invest consistently month by month, then you can get a decent portfolio up over the 20-30 year period. Now, how do you actually buy stocks in Australia? Well, it's very simple. It's not the share dealer like I was joking before. It's actually using a brokerage. Now, brokerage is just a platform or an individual or a company that allows you to buy and sell transactions of stocks. But there are different platforms that you can use within Australia to buy those stocks. I'm going to be talking about these in different categories, and also I'll probably do a longer video examining the different platforms, the pros and cons. And so if that's something that you would like to see, please comment down below and I'll do another video that really goes into deep details into the different platforms and what the pros and cons are. The first type of brokerage is just using your bank. So CompSec is a brokerage, or your other bank may have its own brokerage that's available to you. This is probably the easiest way to get started because it connects to your bank account, and there's probably easy ways for you to set up with just one click. The cons are generally the fees can be much higher than other platforms that are available out in the open. The next category of investment platforms is micro investment platforms, and generally these are platforms that charge you very low amounts to invest small amounts into the stock market. So if this is something you're starting to get into, this might be the best avenue for you to get involved. These are also very interesting applications in the way that they allow you to invest. There are some that invest the spare change that occurs when you spend stuff. So if you spend $4.67 on a coffee, then it'll round it up to $5 and basically invest 33 cents for you into the stock market or into a diversified portfolio. These investment apps include Raise and also First Step are these unique sort of investment platforms that invest the excess. Then you have other micro investment platforms such as CompSec Pocket and Spaceship that allow you to invest very small amounts, and you can also set up direct automatic deposits so you invest even before it hits your account. I generally recommend these platforms for people who are just getting started, who are investing very small amounts, or maybe are struggling to invest. And this is sort of a way for you to dip your toes into the market in a very automated fashion where you don't have to think about it. Generally, a lot of the time people lose money just because of their human emotions, being able to pull out and sell stocks and buy stocks at the wrong time and really overanalyze than just buying consistently every month. So if this is something that you feel like you have an issue with, then perhaps these micro investment platforms and an automated system is probably the way to go. For those who are looking to invest slightly higher amounts and something of the order of perhaps a couple of $1,000s or higher, then I definitely recommend Self Wealth for investing in Australian stocks. It allows you to buy at higher increments, and it just charges you a flat fee of $9.50 per transaction. And so if you think about these micro investment applications, the fees can really add up over time, especially if you have a higher account balance, because they tend to take higher percentages, almost like 0.5% for some of these platforms, as you start to grow your account balance. And also some of these micro investment platforms may not give you the flexibility to buy the certain stocks that you want to. CompSec Pocket is amazing in terms of transaction fees. However, the amount of stocks and ETFs that you can buy is extremely limited. And finally, one of my favorite options for investing, because it allows you to access the US market specifically, that is Stake. Stake is a platform that has 0 transaction fees for buying stocks in the American market. The only thing that you need to worry about is the FX, the foreign exchange that occurs when you transact from Australian dollars to US dollars. And you can really just minimize that by trying to find the best exchange rate, or even using TransferWise to basically deposit your money from a US to US account. So I might do a video on how to use TransferWise and Stake and really optimize your investments into the platform. However, Stake is something that I genuinely really think that everyone should get involved in, because it allows you to get your exposure to the US market in a very easy way. And also you don't need to pay those fees or even the account holding fees. Without these fees, you can basically hold as many stocks as you want and invest as frequently as you want. So this gives you actually a very interesting way to get invested at a micro level and also a macro level for bigger accounts. For those who are interested in Stake, I have left a promo code down below. Feel free to use it. You don't need to use it if you don't want to, but if you use the promo code, you will get a free stock of Nike, Dropbox, or GoPro. So good luck with that, and let me know how you go in the comments below. Okay, so how should you choose between these different brokerage accounts? So I have given in your overview depending on how big your account balance is, how much you're investing, what your investment strategy is, are you investing daily, are you picking different stocks, then different platforms are better for you. So as I said, the micro investment platforms are great for you if you're really struggling to put money aside to invest or really struggling to budget and things like that, and you just want an automated system to get money in, then that might be a good system for you. If your account is getting a bit bigger, then Self-Wealth is probably a better option for you to buy stocks. Finally, Stake is great if you're looking at the US market and really wanted to, well, really bullish on the US market as an investment. But the number one thing that you need to consider is fees. Fees are absolutely important to look at, because if you think about it, the higher your fees, the longer you need your money to grow to get to the same amount. So really consider fees and really be critical about how you analyze the fees that you're paying each month as a percentage of how much money that you're putting in. $2.50 may not seem like a lot for fees, but if you're only investing $100 per month, then that's basically 2.5% in fees, which is a ridiculously high amount. Okay, so that's it for the video. I really appreciate you watching. I know that was a long one, but hopefully it gave you a very comprehensive guide to how to invest in stocks. As you can see, it's an amazing opportunity for you to basically bridge yourself from an individual and own companies. You no longer need to be an entrepreneur and start businesses just to own a company. You can just buy the stocks and buy the ones that you really believe in, or buy an ETF of the market, because generally markets will grow in the future. If you're bullish on the earth or humanity in general, then stocks are generally a good bet for you to be able to grow your wealth over time. Hopefully this has made it so much easier for you to enter the markets and get started. Definitely some interesting reading for you to go out and do is just go check out Investopedia, go sign up for a brokerage account and just start putting in some money. Now is the time to start researching and learning more. So I'll be pumping out more videos weekly about this stuff, such as stocks, budgeting, personal finance, etc. If there's something specific that you would love for me to talk about, please let me know down below in the comments. I'd love to know any feedback that you have or any specific topics that you think I should be talking about. I hope that you enjoyed that video. All I ask in return is that you press the like button and subscribe, and hope to see you all in the next video. See ya.